Good day. Welcome to another session of Folk Tutorials. Today, we are going to look at the qualitative characteristics of financial information, the qualities that accounting information should have in order for it to be acceptable on the standard where it's supposed to be. And so, we are looking at qualitative characteristics of accounting information. Well, accounting information cannot just be produced by anyone in any manner. For accounting information to be acceptable, there should be some qualities that it should possess. Now, there are two broad classifications of these qualitative characteristics. We have, one of them is that we have the fundamental characteristics, and then we have the enhancing characteristics. And so, the fundamental means that we cannot do without it. As for that one, it is basic that we should always go by that. But the enhancing also helps, it enhances the quality of the information that the accountant has produced. And so basically we have fundamental, qualitative characteristics. Alright. And then we have enhancing qualitative characteristics or features. Alright, so these are the two broad classifications of the qualities of accounting information or the qualitative characteristics. We have the fundamental and the enhancing. And so if we want to pick them one by one, we are going to look at the fundamental and then we are going to look at the enhancing. The fundamental qualitative characteristics are two, basically. They are relevance and faithful representation. And so that is what we are going to look at in detail when it comes to the fundamental. We have two of them. And then when we get to the enhancing qualitative characteristics, we are going to talk about four of them. And so 6 in all. Okay, so we are going to look at the fundamental qualitative characteristics of financial statements or financial information. Now, the fundamental qualities I said are two. We have relevance and faithful representation. And so the fundamental is relevance and faithful representation. These two are the fundamental qualitative characteristics of financial information. And so relevance, we say that the financial information must be relevant and then it should be faithfully represented. And so we are going to explain each of them into detail. Now, what do we mean by relevance and what do we mean by faithful representation? Okay, so still on the fundamental, we talk about relevance. Now, relevance of financial statements or financial information means that when we say financial information should be relevant, it means that it must serve the needs of the users. For example, if I need information on purchases, for example, information on sales will not be relevant to me. So what we mean by relevance is that it must serve the needs of the user. Now, also, relevance professionally is defined as it should be able to make a difference. So relevance means that financial information is capable of making a difference. So capable of making a difference. So it is capable of making a difference in the decisions that are being made. Remember that we said that a financial accounting essentially is a recording of transactions, summarizing them into financial statements so that the users of these financial statements will use them to make their informed decisions. So if financial information is not relevant, it will not make any difference in the decisions that they make. So if I am about to make a decision, relevant information should impact my decision. That is the meaning. It should be capable of making a difference in my decision. It should be able to tell me which direction to go in the decision that I'm making. Then we say that that information is relevant. And so relevant information is capable of making a difference in the decisions of the users of financial statements. Now, information relevant information will not be able to make a difference unless it has some qualities, and that is that it should have a predictive value and it should have a confirmatory value, either a predictive value, a confirmatory value, or both. So for information to make a difference, we say that it should have a predictive value or a confirmatory value, or both. And so for relevance, we are saying that relevance information is able to make a difference in the decision of the users. And we are saying also that for information to be able to make that difference that we expect in our decisions, that information should have a predictive value, a confirmatory value, or both. So either of them or combined. I think the combined is the better. So your information or the financial information should be able to predict. And when we say predictive value, it means that information should be able to predict future trends in the same financial information. And so if we are looking at this year's financial statements or with last 2 years financial statements in an analytical way, we should be able to use this statement to predict future performances of the company in question. And so when financial statements have the value to predict future performances and future financial positions, then we can say that it has a predictive value because it has been used to predict the future. Confirmatory value also must be there. Confirmatory value is that after we have predicted the financial statements profitability in the future or performance in the future, we go into the future and we look back to confirm that what we predicted actually came into being or came to pass. And so we look at the predictions that we make and then we compare, and then we know surely that this financial information has been able to predict accurately, because in the future, we are in the future now, and what we predicted has come to pass. And so that is what we mean by the confirmatory value. So financial statements, before it can make a difference, you have either the predictive value, the confirmatory value, or both of them. And we are saying that when both are there, the more relevant your financial information is. All right. Then lastly, I want to talk about the fact that relevance of financial information is affected by materiality. And so we cannot talk about relevance without talking about materiality. We cannot talk about relevance without talking about materiality. What is materiality? We are saying that materiality means that information, or when we say information is material, it means that the information has an ability to make a difference in your decisions. Materiality means that the information, if we say information is material, it means that it has the ability to make a difference or influence the decision of the users. So when the information has the ability to influence the decision of the users, then we say it is material. Now, materiality is relative. So it depends. For example, if you are a company earning profits around billions of dollars or millions of dollars every year, and then there is a misrepresentation, or your accountant fails to record a transaction that is just $1, you will see that auditors may decide to even ignore this because $1 may not be too material. Looking at the size of the profits that are being made every year, we don't really consider $1 as embezzlement or fraud, because we may just have to treat it as a mistake that just happened, because $1 is not too material looking at the volume of profit that is being made every year. But if you come to a business that is making $100 profit a year, if $10 are misappropriated or not recorded, that one we are going to take the accountant on, because that is about 10% of our profits and it's very material. And so there is a range for materiality, and we are saying that materiality is relative. An amount of money that will be material to a company may not be material to another company, and that is what we mean by materiality. And whatever it is, we are saying that materiality affects relevance. We cannot talk about relevance without materiality, because for information to be relevant, then it should be material. And so materiality affects relevance. And so when you go to the exam hall, for example, and you're asked to explain relevance, now, in order for you to get a full professional marks, you need to talk about all these things that I have spoken about today. So when you say relevance, you talk about the fact that relevance means that the information should be able to make a difference in the decisions. Then you go on to explain that for information to make a difference, it should have the predictive value, the confirmatory value, or both. Then you should explain what we mean by the predictive value, and then you explain what we mean by the confirmatory value. And then finally, you talk about materiality as an aspect of relevance. And when you are able to combine all these things, I'm sure that you'll be able to earn your full professional marks so that you can pass your exam. And so you don't just explain relevance and then leave it. You really have to talk about all that. Okay, so that is it about relevance. Okay, so we are done with the relevance. The next fundamental qualitative characteristic that we have to talk about is called faithful representation. Faithful representation. A faithful representation simply means that we say we faithfully represent what we are supposed to represent. Now, let us understand that financial accounting or financial statements report figures, events that are quantified in monetary terms. And so at the end of the year, the report that is being produced by the accountant should be able to report every figure that we are supposed to report faithfully. So what do we mean? If you may just be tempted to say, okay, then it should be represented faithfully. For faithful representation, three things are required before we can say that this financial statement has been presented faithfully. Then it should contain, or it should have three different qualities. So then we say that the information should be complete. That is the first one under faithful representation. Then it should be neutral. That is the second one. And then third one, it should be free from errors. And so under faithful representation, before we say that this accountant has represented or reported the information faithfully, it means that the financial statements are complete. That is number one. It also means that the financial statements are neutral. Then it also means that the financial statements are free from errors. When all these three is combined and reported or adhered to, then we say that they have qualified or they have satisfied the quality of faithful representation. And so financial statements should be complete, neutral, and free from errors. Now, what do we mean by saying that the financial statement should be complete? Financial statement should be complete. It means that the financial statement should record every event that is supposed to be there. In other words, when we are recording, we shouldn't take off some things. We are not supposed to do what we call creative accounting, whereby we bring in what we think is okay and then leave some things out. Okay, so financial statements should contain every transaction that happened within the year. Should all be completely reported. And when we have every detail of a transaction summarized on the financial statement, then we can say that the financial statement is complete because nothing has been left out. And so that is what we mean by completeness. Everything should be reported. We shouldn't hide anything. And then we say that it should also be neutral. When we say financial statements are neutral, it means that it is not distorted, or it was not distorted by the personal wishes and opinions of the accountant or those in management. And that also comes back to creative accounting. So sometimes we are preparing financial statements and we let our personal emotions or feelings or wishes influence the way we prepare the financial statement. And so we decide which ones we think is right to disclose and which ones that is not right. So once our personal wishes are distorting the things that we put into the financial statement, then we are saying that the financial statement was not neutral. And so once it is not complete and not neutral, then we are saying that we are not satisfying the principle or the quality of faithful representation. Then finally, we are saying that financial statements must be free from errors. Financial statements must be free from errors. Now, financial statements should be free from errors in a sense that we should do our best to try and then reduce the errors that are committed in the financial statement to make it true and fair. Now, this quality does not really mean that financial statements can never have errors Of course, because of estimations that we do a lot in financial accounting, there may be some inaccuracies in the kind of estimations that we use in preparing our financial statements, like our depreciation policy and other estimates that we make concerning allowances for receivable, doubtful debts, and all that. Now, because of these estimations, we cannot say that the financial statements are 100% complete. Sometimes we even make tax estimations. All right, but then what we are saying is that it should be free from errors, at least to the barest minimum. We do our best to reduce the errors and make sure that whatever that we have done is complete per hour, and then it is neutral, and that we are not made any mistakes. We go over it to make sure that whatever financial statement that we are preparing is not with errors. We have done our part to make sure that we have eliminated any possible error that we can see, and that we say that when all these three qualities are adhered to, then we are automatically satisfying the quality of faithful representation. Okay, so that is it with the fundamental qualities of financial statements. So, having completed or understood the two basic or fundamental qualitative characteristics, which are relevance and faithful representation, we move on to the enhancing ones, the enhancing qualitative characteristics of financial information. Now, there are 4 of them, and the first one I want to talk about is comparability. Comparability. Comparability means that the financial statements that are being prepared should be able to be, like, it should have the quality of being compared with other financial statements. Now, take note that comparability has 2 different dimensions. Now, the first one is that financial statements should be able to be compared with the previous year's financial statements. And so when we take financial statements of 2020, or no, let's say 2019 end of year accounts, we should be able to compare that with the financial statements of 2018, 2017, and the previous years of the same company. And then we say that the financial statement has the ability to be compared. The second dimension of comparability is that it should be able to be compared with similar firms in the same industry. So the financial statements of this company should be able to be compared with companies that are in the same industry, their financial statements as well. So at least we will look at industry analysis, whereby our financial statements are similar to our competitors or our rivals in the same industry, and then we will be able to compare our financial statements with them so that we can do analysis to boost our performance. So these are the 2 dimensions. It's either we are doing backward what we call it, comparability, or we are looking at a horizontal one where we are looking at our rivals in the same industry, and then we are able to compare our financial statements with their own financial statements. Now, before comparability can be achieved, there should be consistency. So you cannot also talk about comparability without talking about consistency. Now, consistency means that you should hold on to one accounting method throughout or for most of the year, except there is a very big change in the regulations and the law. For example, depreciation policy. If you are a company and you are sticking to the straight line method, for example, it means that your depreciation policy should be your straight line method throughout, so that it will be easier to compare this year's statement with last year's profitability. If you use straight line method for depreciation of your PPE this year, and next year you use reducing balance method, and the following year you use some of the years against method, for example, you are not being consistent with your methods of accounting, and it will be difficult to compare your profits because each of them will give a different figure in terms of how you ascertain your expenses of depreciation. And so if your methods are not consistent, then it will be difficult for comparability to be achieved. And so you cannot talk about comparability without talking about consistency. So anytime the quality of comparability is to be achieved, then we should also know that consistency is key to achieving that comparability. Alright, so that is about comparability. Then the next thing that I want to talk about is called verifiability. That is the second enhancing qualitative characteristic of financial statements. Verifiability. Verifiability means that financial statements can be verified from source documents. So we can trace and verify that this information that you have presented was not created by you, but there is a source document where you picked your information from, and that experts can come and look at it and verify that these things are true. And so that is the quality of verifiability. You cannot just cook figures and think that it will not be verified. Of course, that is why there is auditing. So auditors will come and do verification of all the figures that you have. And so your financial statement should possess the quality of verifiability, so that we will be able to verify every figure that you have put on your financial statement as true. And then we say that it has the quality of verifiability. And so that is with verifiability. The next thing that I want to talk about under the enhancing qualitative characteristics is called timeliness. Timeliness. Please, this is timeliness, not timeless. I have marked scripts of students whereby instead of writing timeliness, I don't know where they are rushing to. You see them writing timeless, timeless, timeless. This is called timeliness. Now, timeliness means that financial information should be presented and provided to the users in the time frame in which it is still relevant. So, timeliness means that you are preparing accounting information in the time period that has been specified by the accounting standard. Timeliness means that you are preparing financial statements within the stipulated period. Usually, because of the periodicity concept, financial statements are prepared in the 12-month period. And also, it should also be timely in the way it is presented and then provided to the users. We cannot provide financial statements of 2015 in 2020. I mean, that is not timely at all. So financial statements should be timely. It should come at a time that it is still relevant, so that the decisions that are made will still fulfill the quality of relevance. And so timeliness must be achieved, and is very, very important. And then finally, we want to talk about understandability. Understandability. Very simple to understand. That is what we mean. That information, financial information, should be presented in a right, there should be the right classification should be used, and then clearly stated in a way that will make it easier to understand. Especially even with the choice of language, we should consider the users of the financial statement and choose language and words or vocabulary that will be easy to understand. And so financial statements should be understandable by the users. That is what we mean by understandability. The way the accountant will be able to make it clear in classifying and making it understandable to the users is what we mean by understandability. And so these four are the enhancing qualitative characteristics of financial statements. And then the first two, which is relevant and faithful representation, are the fundamental qualitative characteristics. Alright, that is it for this video. Remember to subscribe to my YouTube channel and then watch out for more videos. Thank you.